Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. Thanks for listening to the Northbound Wealth Podcast. Today is August 24, 2026. Weekly market insights. Stocks slip, attention shifts to bonds. So stocks declined last week as global investors fretted about oil supply-induced inflation. The S&P 500 index declined 1.43%, its first weekly loss in a month, as U.S. President Donald Trump issued an economic D-Day warning for Iran. The NASDAQ Composite Index slid 2.05%. The Dow Jones Industrial Average slipped 0.85%. The MSCI EFA Index, which tracks developed overseas stock markets, lost 0.4%. Bond yields are up. Stocks are under pressure. The S&P 500 ended Friday's session at 7,674.37. This is the first time the market benchmark has posted a weekly decline since the 5 days that ended July 24th. The index has gained 2.5% in August and 12% in 2026. Trump threatened the most crushing economic operation on Iran while also warning of consequences for countries that support or conduct business with Iran. Iran's foreign minister responded by saying the campaign was bound to fail. Also this week, the U.S. Treasury decided to boost repurchases of long-dated government debt to $4 billion per operation from September. Treasury Secretary Scott Bessent said that the $4 billion amount for the buyback may be the floor, but not the ceiling, that it could be much larger than anticipated. Prudent investors need to discern that smart money and the momentum crowd are reacting differently to the major move by the Treasury. Smart money is concerned because they know that a buyback only temporarily restrains the move in the long-dated bonds, wrote the Aurora Report in their August 21st letter. For now, in my opinion, the strategy is a sufficient band-aid on a larger issue, which is the U.S. government debt reaching $40 trillion with no political will on either side, Democrat or Republican, of prudently managing our ever-increasing national debt problem, especially the net interest payments on our debt, which is now over $1 trillion per year per U.S. Treasury data. I think the current prevailing strategy is to try and outgrow it and pay it down over time, admittedly, a complex issue of our day. Thankfully, the USD, the US dollar, that is, currently the world's reserve currency. We have a strong military and American ingenuity or resolve. However, we must not become overconfident in our ability. Continuing this seemingly long-term sustained path of unresponsible fiscal discipline may catch up with us eventually. Consequences for all people who call America home, if mismanaged, may be felt across all aspects of American life, which entails the world. Everything has a cost associated to it. In other news, utilities had the largest percentage loss this week, falling 3.6%, followed by a 3.4% drop in industrials and a 3.2% decline in technology. Communication services, financials, and consumer staples shed at least 1% each, while real estate and consumer discretionary also edged lower. NRG Energy and Vistra Energy were the hardest hit stocks in the utility sectors, falling 10% and 8% respectively. Airline stocks, United Airline and Southwest, were among the top decliners in industrials, sliding 9.7% and 8.8% respectively. In the technology sector, shares of CrowdStrike fell 12%. The company faces high expectations heading into second quarter results in the annual Falcon conference, BofA Securities said in a note to clients. Investors may need a meaningful net new annual recurring revenue beat to justify elevated expectations the report said. Also, CrowdStrike's global chief technology officer, Ilya Zaisev, stepped down to launch an early-stage venture capital fund focused on cybersecurity. On the upside, healthcare climbed 4.3%, followed by a 2.5% increase in energy and a 2.3% gain in materials. Moderna was the best performer in healthcare as well as the overall S&P 500, more than doubling on the week as the company said Merck said a late-stage trial of an experimental skin cancer treatment they are jointly developing yielded positive top-line results. Merck's shares rose 12%. Economic data next week, or this upcoming week, include the July personal consumption expenditures, or the PCE index, and the second estimate of second quarter gross domestic product. Other data will include July consumer spending, new home sales, durable goods, and wholesale inventories. And I think Jackson Hole is happening here in this week and next. And Fed Chair Warsh is going to be communicating at some point, so we'll be following that. So year to date, EFA foreign markets up about 14, S&P's up about 12 to 13, NASDAQ's up about 12 to 13% this year, and the Dow is up about 10 to 11. The 10-year Treasury rate's about 4.74%. That's up from a year ago when it was around 4.33%. Thank you, Y Charts, for that information. A bee in the bonnet. Last week's yields on bonds issued by sovereign governments around the world rose to multi-year highs, including in Japan and throughout Europe. Investors in these bonds decided they needed higher yields to compensate for ongoing global issues. As a result, the cost to borrow money went up, and because bond prices and yields move in opposite directions, the value of these bonds fell. The Treasury Department stepped in, as we talked about earlier on this podcast, on last Wednesday to say that it would double the size of its current repurchases of longer-term 10 to 30-year Treasury debt. It's uncertain how the move could influence markets, but paying $1 trillion in interest isn't good, obviously. Unused 529 funds. Okay, so we're shifting gears over to 529 plans. Roth IRA rollover for the child. Most of the conversation around college savings is about whether you're saving enough. Fewer people talk about what happens when a 529 plan outlasts the beneficiary's education needs. Maybe your child earned a scholarship. Maybe they chose a less expensive school. Maybe the plan changed entirely. However it happened, you built this account carefully, and now it has more in it than you need. For years, your options were limited. Take a taxable distribution and pay a 10% penalty on earnings, or change a beneficiary and hope someone else uses it. Secure Act 2.0 added a third option. Not everyone knows that you can roll unused 529 funds directly into a Roth IRA for the account's beneficiary. Here's what to know. $35,000 lifetime cap per beneficiary. The account must be at least 15 years old, and the beneficiaries cannot change. That's a key fact. Annual rollovers are capped at the year's Roth IRA contribution limit. So in 2026, that would be $7,500. Only contributions made at least 5 years before the transfer date qualify, and no income limits apply, unlike regular Roth contributions. This doesn't happen overnight. If your 529 has more in it than your child will use, it may be worth a conversation before the money sits idle any longer. So the $7,500, if you think about it, you can roll that money over multiple years to get to that $35,000 lifetime cap per beneficiary. That's how they come up with the $35,000. A 529 plan is a tax advantage education savings plan. Before choosing a plan, it's important to consider not only the state tax treatment, but also any associated fees and expenses. Availability of a state tax deduction will depend on your state's or state of residence, as state laws and treatment may vary from federal tax laws. If you make non-qualified distributions, earnings will be subject to income tax and a 10% federal penalty tax. To qualify for the tax-free and penalty-free withdrawals of earnings, Roth IRA distributions must meet a 5-year holding period requirement and occur after age of 59 and a half. Tax-free and penalty-free withdrawals can also be taken under certain other circumstances, such as the owner's death. The original Roth IRA owner is not required to take minimum annual withdrawals or required minimum distributions. All right, so we're tracking all the key economic data for you. Notable companies reporting earnings this week. Tuesday, Intuit. Wednesday, NVIDIA. We're going to be watching that. CrowdStrike, Salesforce, and Synopsys. Thursday, Marvell Technology and Autodesk. Stay tuned for the next segment. When your parents need you to be the adult, there is usually no single moment when the roles begin to shift. It may be a confusing medical bill, a missed payment, scam text they almost clicked, a question about an account that they had for years, a conversation where they sound like themselves, but not quite as sharp as they used to. Most adult children do not wake up one day and decide their parents need help. They notice small changes, then more of them. And at some point, concern becomes responsibility. That is often when the hardest questions surface. How do you step in without taking over? That shift from being the child who is looked after to being the adult who needs to do the looking after is one of the most complex transitions a family faces. Most families arrive at it without a strategy. A 2026 report found that 27% of Americans admit that they never discussed their end-of-life wishes and have no plans to do so. And 42% state that they would not know what to do if a family member passed away today, underscoring a massive lack of communication. The families who navigate this transition well tend to have one thing in common. They broached the subject before they had to. As financial professionals, we've helped many clients through what can be a challenging time. We thought it might be useful to share our insights by crafting a roadmap you can refer to about this topic. The conversation nobody starts. Behavioral finance offers a useful lens on why these conversations stall. The tendency to avoid uncomfortable financial talks is so well documented that researchers have given it a name, the ostrich effect. When we anticipate that a topic will be emotionally difficult or that the information we might receive could require us to act on something we would rather not face, we find reasons to look away. Conversations about aging parents' finances sit squarely in this category for most families. The avoidance runs both ways. Most adult children are quietly hoping their parents are fine and have their affairs in order so that the conversation can wait. What makes earlier engagement valuable is not just the practical benefits, but the quality of the process. When families work through complex issues while everyone is healthy and unhurried, parents can express their actual preferences rather than have decisions made for them. So putting it off. Top reasons why parents put off estate conversations. Asset misconception. Quote, I do not think I have enough assets to need one, end quote. That's 27%. Procrastination is 23%. They often say, I have not gotten around to it. 17%, there's confusion. I don't know where to start. 15% say cost anxiety. I feel it's too expensive, is what they often say. 12% say that it's discomfort. It feels uncomfortable to even think about. And another 12% that rounds out the percentages is complexity. It feels too complicated. This source is from trustandwill.com 2026. Trust and Will 2026 Estate Planning Report. And respondents could select more than one response in this survey, but I find it very informative. How do you bring this up without making it awkward? The framing matters more than most families realize. Raising the topic as a concern about parents' ability to manage their affairs often lands as criticism, even when there's no intent that it would be criticism. A more effective entry point centers the adult child's own situation. Okay, so mentioning that you've been reviewing your own estate documents or that your financial professional raised something that made you think about the family picture can help shift the conversation from scrutiny to shared preparation. It also helps to keep the first conversation bounded. Propose something specific, such as where important documents are kept or who do we contact in case of an emergency, rather than a broad request to discuss finances. The goal is to open the door, not resolve everything all at once. A family meeting, perhaps facilitated by a financial professional, can help by introducing a neutral third party into the mix, removing the dynamic of a child appearing to question a parent and allowing the conversation to focus on preparedness rather than capability. The legal documents every family should consider: durable power of attorney. A durable power of attorney, or POA, assigns someone to manage a parent's financial and legal affairs if the parent becomes unable to do so. The word durable is critical. It means the document stays valid even if the person becomes incapacitated. A standard POA becomes void the moment the person loses capacity. A springing POA, which only activates upon a formal declaration of incapacity, can cause delays exactly when time matters most. Healthcare proxy, advance directive, and pulsed. A healthcare proxy designates someone to make medical decisions, while an advance directive documents specific treatment preferences in writing. The document most families have never heard of is PULST, POLST, Physician Orders for Life-Sustaining Treatment. This is a physician-signed medical order, not just an expression of wishes, that healthcare providers must follow immediately in an emergency. For parents managing serious health conditions or advancing age, it's often most actionable document in the set. Without these documents in place, a family that needs to make financial or medical decisions on a parent's behalf must petition the court for guardianship or conservatorship. It is an entirely avoidable outcome as long as the right paperwork is completed ahead of time and filed away until it may be needed. 4 documents families should know: again, durable power of attorney, or POA, healthcare proxy, advance directive, and pulse. Organizing the financial picture, you can check this out on the blog, www.northboundwealth.blog, when your parents need you to be the adult. Continuing this conversation, even families who have had the conversation and have documents in place often lack a clear picture of a parent's full financial life. Account numbers, insurance policies, the location of the will, the name of the estate attorney, and the list of monthly automatic payments. These are the details that matter when something happens and can be difficult to reconstruct after the fact. A family financial inventory, so a single organized record of everything a trusted person would need to step in, is one tool a family can build. FYI, something I think of too is passwords, accessing critical documents. The inventory should include bank and investment accounts, insurance policies, pension income, real estate, and professional contacts. Digital access, think usernames and passwords, matter too. Since most accounts are managed online and gaining access after a parent loses capacity can be a lengthy process if you haven't thought it through. Research suggests cognitive changes affecting financial decision-making can begin in their 50s, making early visibility not just useful, but protective. Elder financial exploitation, closer than most families think. This is, it's unfortunate, but elder abuse or elder financial exploitation is one of the most fastest growing financial crimes in the country and one of the most least reported. According to the most recent AARP Public Policy Institute research, approximately 72% of all elder financial exploitation losses, roughly $20.3 billion of that $28.3 billion total, come from known perpetrators, family members, caregivers, and others with trusted access to older adults rather than just from strangers. Higher asset elders are more attractive targets precisely because there is more to take. Warning signs include unusual withdrawals, new names on financial accounts, sudden changes to will or beneficiary designations, and unpaid bills despite adequate resources. One approach is structure, not surveillance. A parent who has a clear estate strategy and adult children with some financial visibility can help an awful lot. So, who's behind elder financial exploitation? Strangers, it's about 28%. Family members, 72%. Most losses come from someone the older adult knows. And that source is aarp.org 2026. What Medicare covers and what to do when it runs out. Healthcare costs continue to rise and can be an unpleasant surprise as parents age. What many do not appreciate is that Medicare does not cover long-term custodial care. It covers short-term skilled nursing facility care after a qualifying hospital stay, fully for the first 20 days with a daily copay of $217 from days 21 through 100, and nothing after that. It does not cover assisted living or ongoing home care. Why does this matter and needed to be addressed? Well, because 70% of Americans over 65 will need some form of extended care with an average duration of 3 years. For some families, Medicaid, which does cover extended care costs, is not a realistic option. It is means tested, and qualifying can mean spending down well below thresholds most financially comfortable families could ever expect to approach. The two realistic strategies are self-funding, which means treating a potential multi-year care need as a portfolio liability, and financial products, which shift that risk to a financial institution. How our firm can help? Well, our firm can help frame and facilitate difficult conversations. We know professionals who can help review the legal documents in place. We can help model extended care cost scenarios against a family-specific financial picture and coordinate with an estate planning attorneys when updates are needed. The families who tend to feel most comfortable about how this chapter goes are the ones who approached it as a proactive exercise rather than a response to a problem. We are glad to be a part of that process, whatever stage a family is ready to begin. Here's some FAQs. At what age should families start having these conversations with their parents? Well, there's no single right age, but research suggests financial decision-making can be affected by cognitive changes earlier than you might expect, starting while the parents are healthy and fully engaged, ideally in their 60s or early 70s, gives families the most time and options. The goal is not to intervene early, it is to be organized early. Another question is, what is the difference between a durable power of attorney and a regular power of attorney? A regular POA becomes void the moment the person loses mental capacity. A durable POA remains in effect even then, which is precisely when it is most needed. Most estate attorneys recommend a durable POA. Families should also confirm whether it is already active or only springs into effect upon a formal incapacity declaration, since the latter can cause legal delays when time matters most. Another question is who is most likely to commit elder financial exploitation? Research points to known perpetrators rather than strangers. For some families, the stakes are higher since wealthy elders are more attractive targets. Protecting a parent's financial interests means establishing clear structures and accountability within the family, not just watching for external threats. So if you have questions on this, feel free to reach out to us at Northbound Wealth. You can check it out on the blog as well. And a lot of the resources are Trust and Will, the Decision Lab, the government websites, Connolly Law, AARP, Medicare.gov, and JRC Insurance Group, and a few others that are there out on the blog. But I thought this was informative for my audience and for my clients. All right. Thanks for tuning in to the Northbound Wealth Podcast. So, sequence of returns, the retirement risk that doesn't make headlines. Two retirees can earn the same average return and have very different outcomes. Why? Because in retirement, timing matters. An early market downturn in retirement can be more damaging than the same downturn later. That is the sequence of returns risk. If you haven't heard it already, you'll hear it here. The risk is not simply the market went down, it's the market went down while income still had to come out. A strong retirement strategy should look beyond average returns and address where the income will come from, how much cash or short-term reserves make sense, which accounts to draw from first, when to rebalance, how RMDs and Social Security fit into the withdrawal strategy. Sequence of return risk does not make many headlines. But for anyone entering retirement, it can be one of the most important ideas to understand. The goal is not to predict the next downturn, it's about being prepared. If you have questions about this and more on sequence of return risk, give us a call at Northbound Wealth Management 317-399-1107. By 2030, women are expected to control nearly 2/3 of private wealth in the United States, representing roughly $30 trillion, according to a landmark 2020 study by McKinsey & Company. That shift is already underway. More women than men now graduate from college. Women-owned businesses generate more than $2.7 trillion in annual revenue. And because women statistically live longer than men, many also manage the final and often most complex chapter of a family's financial life. The numbers tell an important story. Women make or influence a growing share of household financial decisions, yet many still report feeling less confident, less heard, and less well-served by traditional financial preparation. That gap isn't about ability, it's about whether the guidance, questions, and processes reflect the realities of modern wealth. Today is Women's Equality Day. A financial strategy should reflect the life being built and the goals that matter most for women and men alike. Family dynamics, longevity, business ownership, caregiving, legacy, and the financial decisions that shape what is possible. Does yours? If you have questions about this and more, reach out to Northbound Wealth. We'd be happy to talk with you.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.